What is shorting? Shorting or short selling means selling an asset in the hopes of rebuying it later at a lower price. A trader who enters a short position expects the asset's price to decrease, meaning that they are bearish on that asset. So instead of just holding and waiting, some traders adopt the short selling strategy as a way to profit off an asset's price decline. This is why short selling can also be a good way to preserve capital during price declines. Shorting is very common in essentially any financial market, including the stock market, commodities, Forex, and cryptocurrency. As such, short sales are widely used by retail investors and professional trading firms, such as hedge funds. Short selling stocks or cryptocurrencies is a common strategy for both short-term and long-term traders. The opposite of a short position is a long position, where a trader buys an asset in the hopes of selling it later at a higher price. How does shorting work? Typically, shorting will happen with borrowed funds, though not in all cases. If you're selling some of your stock AAPL position at $10,000 with the plans to rebuy it later at $8,000, that's effectively a short position. However, shorting is also commonly done with borrowed funds. This is why shorting is closely related to margin trading, futures contracts, and other derivatives products. Let's see how it works. Let's say you're bearish on a financial instrument, such as a stock or a cryptocurrency. You put up the required collateral, borrow a specific amount of that asset, and immediately sell it. Now you've got an open short position. If the market fulfills your expectations and goes lower, you buy back the same amount that you've borrowed and pay it back to the lender with interest. Your profit is the difference between where you initially sold and where you rebought. Now let's look at a more concrete example. You borrow stock AAPL and sell it at $8,000. Now you've got a stock AAPL short position that you're paying interest for. The market price of stock AAPL goes down to $6,000. You buy stock AAPL and return that stock AAPL to the lender, usually the exchange. Your profit in this case would be $2,000 minus the interest payments and fees. The risks of shortings. There are a number of risks to consider when it comes to entering a short position. One of them is that, in theory, the potential loss on a short position is infinite. Countless professional traders have gone bankrupt over the years while being short a stock. If the stock price increases thanks to some unexpected news, the spike up can quickly trap short sellers. Naturally, if you've been reading Binance Academy, you know that having an invalidation point and setting a stop loss is crucial for every trade. However, let's still talk about this concept because it may be helpful to understand. So, if you're shorting a borrowed asset and the price increases and keeps going up, you'll keep incurring losses. With that said, this is more of a theoretical risk than a practical one, as most platforms will liquidate your position before you'd arrive at a negative balance. Even so, it's worth keeping in mind, as it shows you why it's always paramount to keep an eye on margin requirements and to always use a stop loss. Other than that, standard risk management principles apply to shorting. Protect your downside, use a stop loss, think about position sizing, and make sure you understand the risks of liquidation. Closing thoughts. Now we know what entering a short position is and why traders would want to do so. As we've seen, traders who are in a short position usually have a bearish outlook on the market. Short selling allows traders to profit off price declines, and they can do it without necessarily holding the asset.